This is your host, George Huss. Pull up a chair for module number 4 on making better 401k investment choices. You know how you look at your 401k investment options and wonder how you're supposed to make sense of all this? How to cut through all the gibberish? Once you grasp this simple method, you can smile when anyone pulls you aside to whisper a hot stock market tip they've just got to share with you. In a moment, you'll get a brilliantly simple method grounded in reality. You'll save hours you used to spend listening to the talking heads in the media, the self-proclaimed market experts telling you why the market just went up or down as if they really knew, and all the other experts who are pounding the table telling you their crystal ball can foretell the future direction of the market. What we're going to help you see is a logical, organized, systematic way to measure what's happening in your 401k. No predicting, no forecasting, no more media-driven frenzy pushing your emotional hot buttons. So let's begin. So far, we've used 3 of the top 5 mutual funds found in 401k plans today to shine a light on this method. American Fund's Growth Fund of America, Euro Pacific Growth Fund, and the Davis New York Venture Fund. Today, we're going to review FidelityContrafund. Throughout these episodes, we're highlighting an investment method used by Wall Street insiders now for over 130 years. It's called point and figure charting. Charles Dow, the Dow of the Dow Jones Industrial Average and co-founder of the Wall Street Journal, used this method. So let's get started. FidelityContrafund, and the ticker symbol is FCNTX. That's Foxtrot, Charlie, November, Tango, X-ray. If you're listening in on the podcast and you're a visual learner, grab this episode on the 401k Owner's Manual YouTube channel. If you want the complete transcript, like us on our Facebook fan page. You'll get a notice when the transcript is ready. The instructions for pulling up the FidelityContrafund chart on stockcharts.com can be found in either of the first 2 episodes. As we suggested in the last episode, take a quick look at the chart and notice that the price movement for FidelityContrafund is very similar to what we saw in the Growth Fund of America, Euro Pacific Growth Fund, and Davis New York Venture Fund. From 2003 through 2007, each of the funds demonstrated a series of higher highs and higher lows. A clear visual uptrend until we get to supply winning the battle in the beginning of 2008 through 2009, with each of the funds demonstrating a series of lower lows and lower highs. You'll see the same pattern demonstrated in the last fund in the upcoming episode, and I'll explain at that time why this occurred. If you missed the last 3 episodes, point and figure charting are really easy to read. They're simple square box graphs. Down the far left and far right columns are numbers representing prices. Across the very bottom of the graph, you'll see numbers representing years. Inside the chart, you'll see columns that are filled with either X's, which are prices going up, or O's, which are prices going down. In some of the boxes, you'll see numbers 1 through 9, or capital letters A, B, or C. The numbers 1 through 9 represent months January through September, and A, B, and C represent the months October, November, and December. They're there for reference only because these charts measure price movement, not time. Okay, let's focus on FidelityContrafund. You'll notice one difference in this chart versus the last 3 we've used. Previously, we formatted the charts using a value of 50 cents per box so we could see the price movement more clearly. Here, we adjusted the box size to $1 per box to slow the chart down. Again, so we can see the price movement more clearly. At 50 cents per box, the price is simply too fast, which doesn't serve our purpose. Remember, we're not interested in using this method to jump in and out of investments. We simply want to identify the trend as well as significant price levels of support and resistance in order to manage the investment risk. Okay, we took Davis New York Venture Fund through January 2011, so let's continue there. By February, the chart hit a price of $71, followed by a 3-box reversal down in March. The price continued down one more box to 67 before it completed a 3-box reversal up in April. Demand continued to drive the price up 2 more boxes to a new high of 72. At that price of 72, we also achieved a technical buy signal because there was enough demand to exceed the last column of X's. Remember, technical buy or sell signals are not a call to action. It's simply a term of art used by the point and figure chartist because any investment being measured can only be on a technical buy signal or a technical sell signal. There is no middle ground. We'll cover the importance of this distinction at a later date. By June, supply re-enters with sufficient force to complete a 3-box reversal down and continues to push the price back to 67, where it finds support at the immediate past low. At 67, demand takes hold again in July, completes a 3-box reversal up, and continues to drive the price past the last high of 72 and stops at 73, which is now a double top buy signal because this high exceeded the last 2 highs. Now it gets interesting because when supply returns in August, it's with such power that it completes a 3-box reversal down and continues to drive the price through the near-term support at 67 and continues on to a low of 63. The move below support when the price hit 66 was a technical sell signal. There's a maxim among point and figure chartists that the first sell signal in an uptrend is typically false. That proved to be the case in June 2010. However, we now have a second sell signal in an uptrend, and it's worthy of our attention. There's a brief 3-box reversal up followed by a 3-box reversal down, which follows through to a new low at 62, which is a double bottom sell signal because this low exceeded the last 2 lows. This move confirms supply is in control. Yet there's another push of demand which completes a 3-box reversal up, and the price continues up to a price of 67, which is another buy signal. All this action takes place in the month of August. In September, supply takes back control and completes a 3-box reversal down, and by October we see the price move to 61, which is a triple bottom sell signal. Can you see the constant battle between supply and demand, and that at any given point the chart is either on a buy signal or a sell signal? There's nothing arbitrary about that designation. It's either on a buy signal or a sell signal. There's no middle ground. There's nothing subjective about it. Everyone who understands point and figure charting will agree because the laws of supply and demand are irrefutable. This is why the method is historically referred to as scientific, because anyone observing the same data will come up with the same conclusion. This is not the case with fundamental analysis because given the same company being analyzed, research analysts rarely agree on the merits of a particular investment. Why? Because they each make their own independent assumptions about the future prospects of the investment in question. I won't even go into the buy-side bias of all fundamental research analysis and the ridiculously low number of sell recommendations on the street. The only bias that can enter into this form of investment analysis is human nature, and it does in a number of forms. Think of it as reading instruments in an airplane. There are occasions when a pilot sees the instrument readings but believes they must be wrong. In this case, it's not so much a belief as it is a hope. I've seen any number of investors fall back on the idea that it's different this time and refuse to believe their own eyes. I've done it, and I believe anyone who's ever invested in the market has too. The good news is that the chart will guide you, and hopefully you will not stay wrong for very long. Another form of this bias is forming a preconceived idea about an investment. In other words, an investor may say, I got burned in the international stocks or in the dot-com bubble, and I'll never do that again. This kind of thinking is, I believe, more common among investors who do not practice some form of technical analysis like point and figure charting. They're limited by their emotions because they don't have a barometer which is indifferent to opinion any more than your outdoor temperature gauge. The weather forecast may be for a high of 75 degrees, But if the temperature gauge outside your door says 50 degrees, you'll dress accordingly. The point is, charts will tell you what is. It's up to you to determine what you will do with the data. All this reminds me of what my father told me many years ago. When asked what the stock market will do, J.P. Morgan, banker, financier, and businessman, replied, "It will fluctuate." It's worth repeating. Past performance is not indicative of future results. Charting is about measuring, not predicting. I mentioned before, having used this for decades, I can assure you this is an art, not a science. This is why we measure. We may anticipate price movement, but we do not predict it. If and when conditions change, we change. Remember, in the world of investments, it's okay to be wrong. Staying wrong is what gets expensive. Okay, that's as far as we're going to go with FidelityContrafund. Stay tuned for the next broadcast where we'll be using the Vanguard 500 Index Fund. Don't forget, you can download the transcript of this and past episodes by going to our Facebook fan page, the 401k Owner's Manual. You can like our fan page or sign up for free alerts on our website at yourwealthpreservationcenter.com. If you hope to learn something that you didn't, or you'd like to share something that surprised you, leave a comment on iTunes or below this YouTube video. If you'd like a personal invitation to an online free live workshop, jump over to my sister site at 401kealert.com. Thanks so much. Until next time, I'm George Huss, and this is the 401k Owner's Manual.